My name is Bonnie Watson. Welcome to West Slope Startup Week. We're joined here today with Kyle, who is going to talk about raising a capital round, the do's, the don'ts, and the readiness tips. Before we go ahead and get started, just a couple housekeeping things. I was laughing because I see a lot of the same faces, so you're probably going to get sick of me saying all the same things. But welcome to our second West Slope Startup Week. I have had the pleasure of being highly involved the last 2 years, and I'm the capital track captain for West Slope Startup Week. So get to work with a lot of these really awesome people presenting in our capital track. If you're brand new to West Slope Startup Week, it looks a little different this year. It's a virtual event. Usually it's in person, and we certainly hope we can do that next year. But of course, we're always finding the silver lining. So it's a virtual all month event from July 7th to July 30th. And there's, I'm sure as you've probably attended some sessions, there's over 70 sessions. And it's, in my opinion, from what I've seen, it's just been like outstanding at this point. The beauty of West Slope Startup Week is that really these are entrepreneurs and really an entrepreneurial community from all over the Western Slope, all over Colorado, you know, speaking on and to everything for West Slope Startup Week. So you know, the goal for West Slope Startup Week is not just to sit in and listen to these sessions, but it's to learn from each other and share our stories as, you know, if we're a provider or if we're an entrepreneur or whatever it may be, gain new skills, connect with people. But really the takeaway here is to continue to connect with new and old friends as we go through this. And so my piece of encouragement for everybody is make sure that you go to Slack, make sure that you go to Sketch, make sure that you're connecting after these sessions. You know, this is just the beginning of building this entrepreneurial community. But your job is to make sure that you're connecting and continuing to cultivate those relationships afterwards. So again, we're super excited to have you here today. Just a couple housekeeping things. Make sure that you stay muted. We'd love to have your cameras on. So we have, you know, you can see the faces that are here with us to make it a bit more interactive. Please keep in mind that this is being recorded. This is a session that others will see outside of this live session. So just keep that in mind. And then again, make sure that you guys are connecting in Slack afterwards or via email. I just want to quickly thank some of our sponsors. So US Bank has sponsored West Slope Startup Week as our title sponsor for a second year. This wouldn't happen without them. And make sure that you check out US Bank's workshop series. I've attended a few of them and it's a very, very good series, very interesting. So big thanks to US Bank. Our capital track, so this track right here is sponsored by Green Line Ventures. Our communication track is sponsored by Mountain Dog Media. And our makers track is sponsored by Colorado Lending Source, and our tech track by the CART Group out of Grand Junction. So thank you to all of the people that make this possible. We really, really couldn't do it without you. So without that, with all that being said, I'm super excited to introduce you to Kyle. So he is with New Chip Accelerator and a very, very interesting portfolio, very experienced gentleman. And he's here today to talk about capital, everything you shouldn't do. I'm super excited to hear this. I run the Telluride Venture Fund and Telluride Regional Loan Fund and can definitely relate to probably a lot of what we're going to talk about in this session. So Kyle, thank you for being here today. We're super excited to hear from you, and I'm going to pass the floor to you.
Awesome. Thanks, Bonnie. And you can hear me all right?
We can hear you, yep.
Awesome. All right, so during this presentation, I'll try to touch on kind of as many points as possible at a high level. And then, you know, I'll be happy to take any questions, kind of a Q&A roundtable, you know, as best as we can afterwards. And then I think it goes without saying, but if there's anything that we don't address or you have questions after the presentation, feel free to reach out to me directly, email, LinkedIn, whatever, and we can find a time to chat. I guess first off, you know, I'd like to kind of properly introduce myself. So as Bonnie mentioned, I'm the VP of Startup Success and Investor Relations at New Chip, which is one of the top virtual accelerators in the world, and virtual well before COVID happened. We work with 400 to 500 startups a year, pre-seed through Series A, across all verticals, and we help them get prepared for fundraising. And then we obviously have an investor network ourselves that we introduce our companies to, with the obvious goal of helping them fill part or all of their upcoming round. A little bit about my background. So I'm Michigan born and raised. I started working after graduating from Michigan State. I started my career working for a publicly traded fintech company in Chicago. At the ripe old age of 26, I had a quarter-life crisis and decided that I wanted to get access to startups. And I decided to move to Denver in 2011 to pursue my MBA at the University of Denver, which I graduated in 2013. After graduating, I was hired by a local private equity company to run the business side of one of their portfolio firms, another fintech company. That firm was ultimately acquired by Moody's, the billion-dollar rating agency, at the end of 2015. So it was essentially 6 to 8 of us who kind of turned around a company and got it bought out. So that was a pretty wild experience. That allowed me to actually start my own company with a dear high school friend of mine, a RegTech SaaS platform based in New York City. I stayed here in Denver. We raised millions of dollars from global investors, angels, angel groups, some VC money. That company's still around, hopefully going through some sort of acquisition process in the next year or so. Who knows these days, but I left to actually lead some functional groups at various startups in Denver. I wanted to get back into kind of the Denver ecosystem. I was too heavy on the East and West Coast, and I wanted to give back more to my community. So I've been at a number of different startups here in Denver, both angel and VC backed, mostly in the fintech space. And then as Bonnie mentioned, I recently moved over to New Chip, where I work with our success teams and then investor relations. As you do at startups, everyone's in a hustle mode. I've worn a lot of hats, everything from customer success to operations to business development and product. But most importantly and relevant to this conversation, I was very involved in fundraising, pitch presentations, pitch deck preparation, and then also actually dealing with kind of the more back office operations stuff. So I'm actually dealing with the investor paperwork, ongoing investor relations, and things like that. And then just kind of one side note, inevitably, since I've been involved in startups now for about 9 years, I advise a number of companies on the side as well, everything from tech to a shoe company, and basically help them with go-to-market strategy, fundraising strategy, whatever. So this is definitely a passion of mine, and I'm excited to be here today to talk to you about it. So from an agenda perspective, I wanted to be as broad as possible, and again, if you want to dive deeper into anything, we can do that during the Q&A or afterwards. But fundraising is a process. And there are a lot of things to be considered as you go through that process. So, I'll talk about best practices around preparation, types of investors you may target, some of the different investment instruments used, things to avoid or consider, and then actually dive briefly into kind of the mental approach to fundraising, which I think is an underrated aspect of the process. Many of us know that it's a grind. I know this firsthand. Many of you do too. But many kind of new founders are really surprised at the amount of work, time, the amount of rejection, but also the amount of proactiveness that is required for fundraising. And then it's also a mindset thing too, because you obviously have to find a way to always be in hustle mode while not burning out. So, some of you guys may be experienced founders, which I love and would love to connect afterwards. And your experience may be different from mine, but that's the beautiful part of being a part of a community like West Slope or Techstars or New Chip. Not everything is the same for everyone, and there's so much to learn from others who have gone through it. We've been all put through the ringer, if you will. So kind of the collection of all of our experiences, I think, is extremely valuable. And that's why I love networking and being part of these events. So let's just kind of dive into it. So this kind of seems maybe a little bit too obvious, but the first thing is to actually have a fundraising plan. It's funny because there are many founders and startups who either haven't really thought it out, haven't created one, and they kind of just go by the seat of their pants. They more or less just want to take as many investor conversations as possible. It doesn't matter who the individual investor or the group is. While there is incredible value in having conversations, for example, at my startup, we actually took VC meetings early on just to collect feedback on our pitch deck, presentation, go-to-market strategy, channel partnership strategy, whatever, without the intent of actually wanting or needing their money at the moment. You do have to kind of consider how valuable your time is. And it's so easy to go down a rabbit hole of just random meetings that steer your focus away from more valuable ones. So my recommendation is to be tactical. Take investor meetings early on if you think they will help you become more comfortable pitching. Take meetings if you want to collect feedback, But at some point, your meeting should have the primary focus of raising capital, which again is obvious, but as part of that process, you want to make sure that you're focused on targeted investors and not just anyone who will take a meeting. So my ultimate kind of recommendation is just to write out a plan and use it as at least as a framework or guide in your fundraising process. Doesn't mean you can't deviate from it, but it provides direction. It creates kind of team buy-in where it's needed, and it improves execution from my experience. So, I guess just to kind of get started here, firstly, what investors are you going to target? This answer is different for each company. So unfortunately, there is not just one right or wrong answer. And I think it's based on a number of different factors. Firstly, your existing network. Do you have access to certain investors already? And if so, maybe it makes more sense to pick the low-hanging fruit, kind of the easy introduction, if you will. Now, even if these investors don't invest in companies like yours, again, it's beneficial to have a few early on where you can get your feet wet, get more comfortable with your pitch and presentation, and just better understand the types of questions that investors ask. Because there will be a lot of questions that investors ask, and you can never predict what they are going to ask. So the more times you can go through and have some sort of repetition with your pitch and receive that feedback is super valuable. So my first recommendation, from a fundraising planning standpoint and who you're going to target is if you do know any investors personally or you know people who do, get a soft intro. Most people are willing to do favors for friends, so don't be afraid to ask. Another kind of factor that I look at is what round are you raising? So if you haven't raised outside capital yet, maybe you bootstrapped or you just raised a triple F round, which for those that don't know is friends, family, and fools. You may have more success finding kind of angels, angel groups, or even some family offices that are more active in earlier rounds. There are definitely VCs and private equity firms that do pre-seed investments. But I typically advise the companies that I work with and advise to research, the success rates with these investment groups when it comes to startups like theirs. Look at the investors' prior investments, see if they have an appetite for your company, from an industry or vertical perspective, but also where you are in your company life cycle. We'll kind of touch on this later, but there are definite prerequisites for investors on revenue. So some are okay with pre-revenue, others have a specific mandate. Another thing to consider when you're targeting investors is what is your preferred investment instrument? And again, we'll talk about this later, but for example, if you want to raise money via a convertible note round, you'll likely not get great interest from venture capital. They historically participate in equity deals. Angel groups are a little bit more receptive to convertibles. So that's just something to consider. Now, you may not actually have a preference on what investment instrument you use. You should also talk to your lawyers about that. But if that is something you're very strong-willed about, that you want a convertible note, for example, then that'll kind of dictate also the type of investor you'll want to target. Another thing to consider is, what industry vertical are you in? Investors are pretty clear on their websites about their investment strategy. So, if they are industry agnostic, they'll tell you and feel free to go after them. They only focus on B2B fintech companies and you don't fall in that category, then don't waste your time pursuing them. There are great resources out there like Crunchbase, PitchBook, others, AngelList. You can go and filter and find the investors that are active in your industry. So the ultimate goal is to use all these factors to try to whittle it down to a manageable number and then actually go out and engage them in a meaningful capacity. Another thing is, where is your startup based? Obviously this is a Colorado-based kind of organization that we're all a part of and active in this presentation, but not all geographic preference is not necessarily a critical component for investors. But from my experience, being in the same city or state helps to at least get dialogue going. So finding local investors that like at least working with local companies is beneficial and something that I recommend companies to do. I touched on this earlier, but are you pre or post, kind of revenue? There are some investors that won't touch pre-revenue. There are organizations that have strict kind of mandates on revenue. For example, Kretsu, which is one of the largest angel networks in the world, they have an office, it's an angel syndicate group, essentially. They have an office here. They have a pretty strict requirement on revenue. Don't quote me on this, but I think it's like $250K annualized at a minimum. So if you don't have that, then they're not the right investor right now. It doesn't mean that you can't engage them and just kind of learn about their process. But for the list of companies or investors that you really want to target, I wouldn't necessarily include those that have those hard revenue kind of mandates. So with these factors, figure out who are your primary targets. Angels, angel groups and syndicates, there's plenty out there. VCs, micro VCs, corporate venture funds. I mean, hell, you can even look at grants if it makes sense for your company, especially in rural Colorado, where you might have an ag tech play or just a straight agricultural play. There might be some real opportunities for grants. Now, one of the things that I list here is crowdfunding platforms, and I'm not sure how familiar everyone is with kind of the crowdfunding landscape these days, but I'm not talking about your Kickstarters or your GoFundMes. We'll get into this later, but Regulation CF, which was adopted in 2016 through the Jobs Act, was basically a way to reduce regulatory restrictions, making it more possible for companies to raise capital from both accredited and non-accredited investors. You can raise up to a little bit over $1 million, even though there's actually been recent talk on raising that amount. And since Reg CF was enacted, there have been a large number of very reputable crowdfunding platforms that have seen great successes. And by the way, on these crowdfunding platforms, you can choose to do a convertible note round, an equity round. There is variability. So companies like Seed Invest, Republic, NextSeed. I actually haven't been intimately involved in any crowdfunding raise myself. I do know companies that have done quite well with it. So I do think it's something to consider and shouldn't just be washed away because you think of crowdfunding as a Kickstarter campaign. Also, if you're a B2C company, I think it's kind of interestingly enough, a really great business development tool because you do reach, even if people aren't investing in you, they're looking through your profile on these platforms and they're at least becoming aware of your brand. And so, but obviously the investors who participate in a crowdfunding platform are hopefully folks that will then buy your product or service after the fact. So again, just something to consider. It's kind of an interesting space right now, but I think there's a lot of validity to it. All right, next thing on kind of the fundraising plan, now that you know the investors that you're going to target, how do you actually engage them? It seems really easy, but I talk to hundreds of startups, a month, a year, and they always struggle with actually engaging them and getting a first meeting. It's whether there's no response or it's not a favorable response or whatever. For me, the first thing for any startup founder to understand, and I hope that anyone who's way more experienced than me would agree with, is that investors are just like us. Right? They want meetings. They need deal flow. You may not be getting a meeting with a partner, but you'll be getting a meeting with the associate. But ultimately, don't put them on a pedestal. Be direct, be proactive, but also be respectful. I think an over-aggressiveness is off-putting. I've been an angel investor, and I've had people be extremely aggressive even after I've declined. It's not something that I would recommend anyone doing. However, that being said, I do think, and I'll touch on this later, but I do think FOMO, fear of missing out, is actually a real thing in the investment process that isn't used efficiently. And so if you have an investor that kindly declines an opportunity to continue the conversation, but they like you, they like your business model, they want to see where you're at in 3 months, 6 months, a year, be proactive in sending them updates. That is how you create this kind of FOMO culture. And then they're going to be the ones who in turn will be proactive, reaching out to you and saying, hey, saw that you had a great update a month ago. What's new? Let's have another conversation. I think you can't understate, that type of process. So I guess back to the topic of actually engaging investors, firstly, as mentioned before, tap your existing network. Someone knows someone who knows someone. I mean, obviously in this community we have here now, I think at least getting one investor conversation hopefully is not as much work as you would think. Work the connections until you get a meeting. Obviously in COVID, I think we're in an interesting time right now where people are just even more receptive to get on a Zoom call. And so, be aggressive to a degree and just try to get those meetings with people who are friendlies. Another thing that you can do that actually has worked well for our new chip community is direct outreach on LinkedIn. You know, as long as you kind of keep it short, keep it to the point, you don't want to send a novel about your company. But, you know, if you send 100 LinkedIn messages out and you get a 2 to 5% response rate, shit, that's pretty good. I mean, you want at least like 2 to 5 meetings. That's a really good start. And you never know where those meetings are, you know, what they're going to turn into. They could turn into subsequent meetings with the same investor. They might introduce you to other people in their network. You just never know. But I would not shy away from LinkedIn. Don't post it on LinkedIn as a, we'll talk about that later, but don't post it on LinkedIn, but just, you know, messaging an individual investor or emailing is fine. But I would just recommend keeping it short, to the point. Don't go into kind of like a laundry list of KPIs directly in the email. You know, if it's longer than a page, they're probably not going to read it. But again, investors want meetings. So if you have some data points that are super sexy and you lead with, you're going to get a meeting. Lastly, and this is obviously hard in COVID times, but I recommend going to events, especially locally. Rockies Venture Club is great at putting on events. Techstars has great events. The Colorado ecosystem is incredible for startups, so definitely use it. All right. Now that you kind of have figured out kind of what the type of investors that you want to go after, and how you're going to engage them, you also need to know, though, you know, what is the amount of money that you actually need to raise? What is your runway? You know, how much are you asking for? You know, again, this seems obvious, but where I think startup founders drop the ball is that they don't think through this completely, thoroughly. It can be easily picked apart. It's not necessarily that they just pick a number, but there's kind of little analysis done in creating that number. So if I'm an investor, I want to know what the use of funds are going to be for, firstly. So is it for building partnerships, building tech, marketing and sales campaigns, hiring better talent, whatever? Firstly, that information needs to be clearly articulated in your pitch deck, but that's how you kind of backtrack into, you know, how much money you actually need to raise. Most startups raise capital for 12 to 18 months of runway. Again, this can be calculated sometimes easily. Other times you have to use assumptions that are harder to be confident about, but ultimately you need to have a strong pulse on your costs. So, you know, depending on your type of company, what are your COGS, what's payroll like, what are your planned marketing expenses, things like that. Now, speaking of payroll, this is going to be maybe a little bit tangential, but if you are a founder or co-founder who plans to use some of the funds raised to create a kind of larger than 100K salary base for yourself and other founders, I'll tell you right now that you'll get considerable feedback pushback from investors. I actually just saw it this morning with the New Chip Accelerator company, who very, very good company. They had 160K a piece put aside for the CEO and the CTO, raising a seed round. That is not going to fly with many investors. They want to see that you're going to put the money towards the business and not your pocket. There will be a time for that if and when the company is successful, but that's something to be kind of cognizant of. And then finally, you know, what are your kind of key milestones? So if you are raising a seed round and then you obviously hopefully want to raise a subsequent Series A round, what key milestones do you want to hit with that seed money that will then prove to investors that you've successfully, you know, done those investors right in the seed round, and that new one should come on in the Series A, and the existing investors should also be a follow-on participant. So have very clear KPIs so that you can then relay those back to not only existing investors, but new ones. So I think those are kind of the main things that I would recommend for kind of figuring out and articulating to investors, you know, how much money you need and why. All right, we're going to dive a little bit into kind of the type of raise that you want to do. Now, firstly, I am not a lawyer. I don't look like a lawyer. I don't hopefully act like one. But engaging legal is necessary here. However, I do think it's important for founders to have some sort of base knowledge on the different types of private placements that they could do. Reg D, for example, is kind of a catch-all fundraising method. It's what most angels and venture investors use to invest in And there are basically two types of Reg D offerings that a startup can choose to take. You have 506B and 506C. 506B is probably the more often used. It allows for 35 non-accredited investors, unlimited amount of accredited investors, but it needs to be hidden from the public. Meaning you can't go on LinkedIn and post it. You can't do general solicitation. You can't say, hey, I'm raising money, invest in me. Now, 506C, on the other hand, you can do that. There is some additional kind of administrative burden associated with it, but it essentially allows, non-accredited investors are not allowed, and accredited investors must self-certify their standing as well. So those are just kind of factors to consider. So if you're raising a Reg D round, which one is right for you? And kind of depends on your network of investors. If you know a ton of accredited investors, you would likely just do a 506B. Likewise, if you know a bunch of non-accredited investors, you would also do kind of a 506B. But if you want to be open about raising money and reach out to anyone, everyone, then you would probably want to do a 506C. Again, even though the administrative burden is higher. I won't touch on kind of Reg S much, but basically a way for a U.S. company to engage with non-U.S. investors and only non-U.S. investors. Again, we talked about Reg CF earlier, but essentially, in order to participate in a Reg CF, you have to be incorporated in the U.S. Your primary place of business in the U.S. or Canada. You can raise only a little over $1 million. You must not be a bad actor, things like that. A few things to consider with Reg CF. It's easier access to capital. It tends to be faster, less costly access for younger companies, which kind of allows founders to focus less on regulatory compliance and more on getting their products and services to market. On the flip side, you have more investors to deal with. In a more traditional Reg D round, you may have 5, 10, 15 investors at most to manage. In a Reg CF round, it could be hundreds. And while crowdfunding investors are typically less involved in their companies, there still may be kind of logistical challenges and costs associated with doing a Reg CF round, such as hiring an investor relations individual or a communications person to kind of deal with that. Now, Reg A Plus, won't get into it too much. It's basically a mini IPO with a lower reporting requirement. It's kind of more of an end game for a normal startup. And the market's still trying to figure out the best use for these, but wanted to at least mention it. Okay, moving to the next point, let's talk about kind of investment instruments. So convertible notes are pretty typical for younger startups. The company I co-founded, for example, we did a couple of these rounds to start before going into an equity round. Convertible notes are essentially a hybrid debt equity instrument. You have an interest rate, valuation cap, discount rate, et cetera, maturity date. The investment converts to equity upon a defined conversion event, or the note can be paid off at the maturity date. You can also extend the maturity date, which is not terribly uncommon for startups. Equity arrangements, investors buy shares or units in the company for ownership. In return, they hope that the company is acquired, goes public, or pays dividends. SAFE is hopefully something that you guys have heard of at this point. Simple agreement for future equity is kind of a Y Combinator thing, and is becoming, or it already is quite popular for early stage startups, and it essentially grants an investor the right to purchase equity at a future date. Unlike a convertible note, it is not a loan, it does not accrue interest or have a maturity date. And then also, you could always look at direct loans or grants as well. All right, now moving on to kind of a separate topic about preparation and kind of material preparation. I've worked with hundreds of startups, and the common thing I hear from a founder is, I didn't realize the amount of work that went into fundraising. And they're not necessarily talking about the amount of conversations they're having with investors, because that is, of course, a lot. But it's actually being prepared from a document perspective. There are so many things that need to be kind of in order prior to engaging with sophisticated investors. And if you fail to do so, then they're more than likely just not going to be interested. And we'll kind of go through, data room, cap table, pitch deck, pitch presentation. It's funny, like I always think that a pitch deck is it's a living, breathing document that never dies. And trust me, I wish a pitch deck could die, because I've worked hundreds and hundreds of hours on just one. But unfortunately, it's just constantly being iterated, and as it should be, because your business is changing, you're getting feedback from investors, you're hopefully raising a round and then raising a subsequent round. And so a slide deck, a pitch deck is kind of always in transition. First, we'll kind of talk about the data room, though. So a data room is, everyone kind of knows what a data room is. It's essentially a centralized repository for kind of all your relevant information that an investor would need in order to analyze the opportunity and make their investment decision. So I've listed here a number of key documents that I'll briefly touch on, but by no means is this comprehensive. I recommend to startups that they just data dump as much as they can. I also, mentioned here a few tools. I want to do a shameless plug. The green logo is a company called Equa that is Denver-based. I actually worked at it, left to join UChip because I'm actually moving to Austin, Texas, where they're based. But Equa is a great company in Denver, locally found and owned, and they basically do cap table and data room services. I digress. But so corporate governance documents. So investors are going to want to see your articles of incorporation, your bylaws, any early board consents. They're going to want to see existing equity agreements, typically with founders or early employees. They're going to want to see if you've raised the prior investment round, you're going to want to see those documents. So for example, for a convertible note, if I'm an investor in a company, I'm going to want to see the actual forma note, a subscription agreement if there's one available, the term sheet, signed board consent. So having an exhaustive list of these kind of materials is going to be extremely important, because if an investor, especially a sophisticated one, I'll go back to kind of Kretsu. Kretsu will do such a thorough due diligence on you and your documents, it will astound you. And the more you're prepared early on in your company life cycle, the better. You also want to add kind of your business plan documents, anything in regards to vision, strategy, execution, product roadmap, tech stack, super important, obviously, if you're a tech company. Many investors are extremely tech savvy, or they have someone on their team who is, and so they'll actually want to see as detailed information as possible. Now, again, you have the flexibility and power to say, I don't want to provide that until we get to conversation 3 or 4. But that is something that's probably going to be asked towards the later stages of due diligence. Now, from a financial statements perspective, they're going to want to see both actual and projected. Projected financials are always interesting to me. I've seen hundreds. It's always interesting to see kind of a startup projecting that they're going to make like 50 million in year 2. Projections are typically bullshit, but as long as you have assumptions and data points to back it up, that's kind of all that matters, because inevitably you will be asked about that in your pitch presentation. So what I just recommend to startups is focus on your reasonable growth expectations as much as possible. Now, data rooms aren't complicated. You could use Google Drive, Dropbox, doesn't matter. I just encourage people to start collecting documents in one central location earlier on, because it can be a nightmare after the fact. All right, so on to the next one, cap table. This will actually be one of the items in your data room. And for those that don't know what a cap table is, capitalization table basically lists all of your shareholders, the number of shares that are allocated to each of them, their fully diluted percent. There's different things that you can have listed on there, but that's basically the gist of it. One thing to mention, though, is that it's absolutely critical to keep an updated and accurate cap table. Not just because prospective investors will ask for it and many will require it, but because mistakes can be very costly. As an example, I worked with one company that had to pay lawyers $50,000 to create a 300-page remedy document to fix a shitty cap table. And what they basically did is they half-assed documentation execution and necessary process. So they didn't have, if they had a restricted stock agreement, only one party signed. They didn't have a board consent acknowledging the right for these shares to be distributed to that individual. It was such a nightmare, and they had a very interested Series A investor who essentially said, I love you guys. I will not touch your company for an investment until you fix this up. So I think it just goes to show that the more you can be prepared, proactive, do things in real time. Obviously, as a startup founder, you don't enjoy the administrative BS that comes with it. However, there's extreme value in at least having you or someone else do it, because the ramifications could be pretty severe. And again, sophisticated investors aren't going to just kind of blow over it. They're going to be reviewing these documents ad nauseum, and they will find things. And so the more you can do, and obviously your lawyers should be, helping out with this. But again, lawyers are expensive. And so naturally startup founders are not going to go to them every time for these administrative tasks. And so it's just something to either be comfortable with doing yourself, because it's not terribly complicated, or just know that, or just learn from your lawyers on what you need to do. Now, kind of a few best practices for a cap table. Cap tables are kind of near and dear to my heart because I've been heavily involved in them now for about 6-7 years. If you're a founder or early employee at a startup, understand dilution, particularly before taking outside capital. Dilution is, the decrease in ownership for existing shareholders. That happens when a company issues new shares. I think for every startup founder or executive, it's important to understand that. Understand the different types of securities that are issued. So many, founders are provided common shares, when an option holder, when their shares are vested and they choose to exercise, those typically are common shares. Preferred shares, typically more used for, for investors, warrants, options, things like that. I think it's very important for a startup founder to have a really solid base of information there. And then understand conversion events. If you're starting out with a convertible note round, understand what triggers that. Typically it's an equity round. But if it's not, just understand kind of that clause in the agreement. All right, we're going to switch gears and kind of dive into a pitch deck. And I know there's been a bunch of pitch deck sessions, for this West Slope event, but I'll just give a little bit of kind of small tidbits. Pitch decks are the bane of almost every founder's existence. And if you don't know that already, you definitely will, because they're constantly in flux. You're getting critical feedback all the time. You're iterating it, and you're also spending a ton of hours and a ton of dollars, whether it's with designers or whether it's just time. But a pitch deck is extremely important. I mean, it's your first and best opportunity to get investor meetings. And it also clearly provides the investor, or hopefully provides the investor, a well-rounded synopsis of who you are, what you're building, and where you want to go. And then most importantly, how you plan to get there and why you're the best person to do that. One of the complicated parts of a pitch deck for founders is figuring out what to include, because there's so much you want to say. What I tell companies, I advise that you want a 10 to 12 slide presentation. Anything more is going to be excessive. My old company, we had a slide pool of 100 slides, and we mix and match them depending on who we were talking to, the nature of the conversation, and whether it was a first one or a fifth one. And we kind of put together these customized pitch decks. Now that's a lot of work, but we felt that we were prepared because we had all those slides at our holster. Now, one thing I would want to stress though is that if you are a visionary founder, which most founders are, and I think it's a great thing. So when the company I co-founded, my partner, she was a visionary founder, a brilliant one. I was more the strategy and tactics type of guy. Visionary founders I love and respect, but the one thing when it comes to the pitch deck that I can't stress enough is that you need to also highlight your tactical and strategic plan. So instead of just talking about this grand vision that you hope to achieve in 5 years, if I'm an investor, I want to know, how are you going to get from phase 1 to 2 to 3 to 4 to your ultimate goal? So if you're a tech company and you're building an MVP, which is a minimum viable product, tell me, if it's not there already, how are you going to get there? How are you going to turn MVP into V1? How are you going to increase user traction to then, get into, V2 and expanded, functionality and modules? All of those things that are things that I want to know. And if you just have a high level visionary approach to your deck, you're going to probably get picked apart in these investor meetings. They're going to ask about it, and hopefully you already have the information. But you can reduce those types of questions by just already having that stuff in there. And then finally, kind of in a pitch deck, presentation, you want to make sure that, you're very open to adjusting things. Any startup founder should hopefully be open for constructive criticism. Your deck is going to be critiqued a lot, hopefully by people who know what they're doing. And so just kind of take those, tidbits of advice. Now on to kind of the pitch presentation. Now, if I had to kind of, stress, I mean, obviously I can't stress this enough, but practice. This is your one opportunity to get a second meeting with an investor. Know your stuff, not just in the presentation, but for all possible questions. So start collecting lists of questions that people ask and know how you're going to respond. You're going to have meetings where you can't answer something on the spot, and that's totally okay. But constantly improve and get to the point where you can answer almost everything. In the presentation, be engaging and passionate. Again, this is so obvious, but I was talking to an investor last week, and he said, I invest in people, not companies. And I would venture to guess that is a larger majority of investors than you would probably think. And so if you show passion, obviously, hopefully you have intelligence on the market and product that you're building and targeting. But if you show that passion, then you're likely to at least have someone in your corner. And if maybe your company's not right for them yet, they will be someone who they will introduce other people to. So I would just say, passion goes a long way. From a structural standpoint, I like to keep presentations between 5 and 7 minutes, followed by Q&A. Now there will be times where you can pitch longer, but anything over 15 minutes is going to be, quite excessive, and you risk losing your audience. I kind of recommend people going into a brief intro so you can build your credibility, define what you're trying to fix. Why are you the right person to do this? That's basically what an investor is asking themselves. And then get into a demo of the product or a more detailed description of your service, followed by kind of the business stuff, go-to-market strategy, channel partnerships, etc. And then finally kind of come to a landing point that hammers your final value adds home. So, you want to finish the presentation with a bang. All right, so continuing on to kind of more pitch presentation stuff. I listed here some kind of mistakes to avoid. Again, some of them might be a little bit obvious, but you'd be surprised. Mistake number 1, pitch is too long. Your pitch deck is too long, and hence your pitch presentation is too long. So if you focus on 10 to 12 slides in a 10 to 15 minute presentation, then you're kind of forced to pick and make the presentation as direct as possible. There's no fluff. You're hitting all the key data points, and so I would just recommend making sure that it's not over excessive, because again you'll kind of lose your audience. Another mistake is missing something that is important. Obviously, in a short presentation, you can't touch on everything, but again, if you're a visionary and you fail to include strategic product sales or marketing initiatives, that will kind of feed the interim steps before you realize your vision, and you'll be bombarded with questions afterwards and possibly concerns. Now, mistake number 3 is kind of being naive. So most investors won't sign an NDA, so don't ask. Most people, if you say you don't have competition, that's bullshit. Status quo is competition. And then finally, if the investor doesn't fit, your company doesn't fit the investor's kind of investor profile. If they don't invest in ag tech and your ag tech, then by no means, don't waste their time. Be respectful. And then, maybe just provide them company updates, and maybe they'll be interested enough to introduce you to someone. All right, don't underestimate the process. So hopefully by now you kind of know this, but fundraising is a process. It takes many meetings to get investor dollars, 5 to 10 at least. Know that, accept it. There isn't much we as startup founders can do about it. So just be proactive. Now, also, the process doesn't stop after a meeting. Don't wait until the next meeting to be engaged with the investor. Push them respectfully. Provide them weekly, monthly, quarterly updates. Even if they opt not to invest, provide them anyways, because create that FOMO. And then again, if you have a bad presentation or they aren't interested in, and the rapport just wasn't there, then be respectful and kind of just let the relationship go. Many investors do want to know how you're doing because they are rooting for you. They've probably been there themselves. So just be proactive in kind of reaching out to them, articulating your kind of core KPIs and milestones achieved, and just keep that dialogue going. From my own experience, we had investors turn us down many, many times. And then once we secured a massive partnership, we reached out to them and they're like, let's talk again. And it turned into a investment. So that would not have happened if we didn't, one, remember them, and two, have the balls to reach back out even after they turn us down. All right, next, and we're almost done. Don't think fundraising is a part-time job. The founder and CEO should be at the forefront of your fundraising efforts. And if not, then you better have someone very, very close who's intimately involved, who knows everything, and there is no, there are no gaps between CEO and that individual. So just know that it is a full-time job. Now, as a founder and CEO, you obviously want to focus more on the sexy stuff, which is your business. However, your job is to raise money and keep the business afloat. And so you should be very focused and active in your pitch deck creation and iteration to the actual presentations. Then after a round is completed, take a breather, but then it's time to start getting back out for that and figuring out what a next raise looks like. You don't have to spend as many hours, but you want to be prepared so that you don't have to come to a point where like, oh shit, I have to raise money in a month or two, and I just need to start the process. That's going to be extremely stressful and very difficult to achieve. All right, now know how to talk to investors. And I think this is a big one because you need to understand that you are the expert here. You need to be confident in that. The investors likely don't have the experience or knowledge to understand your business, or they just kind of have service level information. Now that's not always the case, but you need to feel like you are the teacher. So you know the value you provide and be clear in that. As part of that, focus on key KPIs to validate your business. Are you decreasing costs for customers? Are you increasing efficiencies? Whatever. And then remember that not all no's are created equal. What I mean by that is just because you hear no from an investor, and trust me, like we've talked about, you definitely will hear no's. It doesn't mean you should stop being engaged with them. Continue to provide company updates if they are interested. But again, you need to provide updates around those KPIs or they're just not going to care. All right, this I kind of touched on. Don't just focus on vision. I'm going to skip this because we definitely, I definitely, probably went too long into that. What I'll just say is vision is a super critical component of every startup because it's what fuels you, but don't forget kind of what is going to get you from now to that completion. And so be passionate about the vision, but also don't neglect the tactical and strategic data points. All right, now finally, this is the last slide. First I want to thank everyone for listening and hope you at least got some sort of value out of this. Last thing I kind of wanted to touch on is attitude and perspective, which I don't think can be overstated. Fundraising can suck, fundraising can be fun. Regardless though, it takes time, takes effort, takes commitment. And at the end of the day, it's about relationships. So foster them, build rapport, know that rejection is going to happen. I say don't be an asshole because if I'm an investor, I don't want to deal with an asshole founder. You're more likely to get people in your corner if you're a good person who kind of builds your network. We're all stressed. We're all working lots of hours. So I don't think it's an excuse to drop the ball on that front. And then I'll just say that investors. I'll finish off by saying investors invest in people. Of course, it's backed by ideas, products, and services, but investors are betting on you. So when you start realizing that, it makes the whole process worth it. There'll be times of great stress, great satisfaction, but always know that you have people in your corner. And obviously with the Denver community and the Colorado community, we're a community that wants to help each other. And so do not hesitate to kind of reach out and ask questions. So I'll stop there. If anyone has questions, I'll stop sharing. And if anyone has questions, I'll do my best to answer them.
Kyle, I think there's a great question in the chat by Robin. She said, to your point about salary,
Mhm.
how low is too low, how high is too high. Can you give some feedback there on what that
Yeah.
should look like?
Yeah, I'll be, super candid. The company I co-founded, myself and my co-founder, we were at 60K a year, and it was a number that that our mentors and advisors recommended, and it's just one of those that is, it's not off-putting, and hopefully it's enough to survive on. And again, it's dependent on everyone's situation. But even other companies I've been at, I know that's been typically the mark. And again, that's more dependent on where you're at in your company life cycle. If you already raised a seed round, considerable seed round, a few $1,000,000, for example, you can have a larger salary, but it's like kind of the pre-seed that investors will really bulk at that number.
Hi, I have a question. My name's Tina. I'm in Olathe, Colorado. And we do CBD extraction equipment, and we're kind of more engineering focused, and we're looking to sell our technology to someone who's more set up in the manufacturing space. Do you have any suggestions on who to approach or how to go about that?
Sure. Well, so one thing, on the investor kind of, building investor relationships, even if they don't choose to invest in you, I think there are going to be a lot of investors that would probably know people in the space. If you're kind of doing some sort of, it's basically kind of like a channel partnership play is what you're, kind of describing to me. I candidly don't have a ton of experience on the manufacturing front, but I definitely know people who do. So what I would say is shoot me a note afterwards, and I'll probably have a better answer, but that is definitely not my expertise. But in terms of kind of just a general strategy point, if you have kind of targeted folks that you would like to sell into, or would like to, you think it's a good opportunity for them to white label your product or whatever, I would not hesitate to do research and then reach out to them directly. You'll probably know someone who's, loosely or, even, more than that connected to the company. But beyond that, I mean, channel partnerships are essentially just kind of a relationship game built over time. But I don't kind of have that manufacturing specific knowledge.
Great, thank you.
Hey Kyle, this is Roman.
Hey Roman.
How's it going?
Good.
So at Allison's, we create always connected asset trackers. I have a question in regards to pitching to investors.
Mm-hmm.
At our company, we only have one founder, and that's me, but we have a good core group of executives. My question to you is, how do you manage the dynamics of other companies that have co-founders or just one founder with bringing them along in some of these pitch presentations?
Absolutely. Yeah, no, great question. And so Roman actually just started as a accelerator company at New Chip, so we'll be working close together. Great question. What I would say, and actually we mentioned this in the New Chip curriculum content, is that the ideal number of founders, and it's more for tech companies, is two. You have kind of a CEO and you have a CTO. But that being said, I've been part of plenty investor conversations with like the Kretsu Network, for example, where the founder did not present. It was actually kind of the subject matter expertise, whether it's the CTO, CFO, whatever. It kind of depends on who the company is and who the investor is. I don't think you should feel like as the founder, CEO, that you have to be always the primary point person on that, but I would recommend definitely being it. But there are circumstances where it makes sense to to use someone else. As an example, sat in on a number of conversations with biotech and pharma companies. And the CEO tends to be kind of more on the business side. And obviously they have kind of like a chief scientist, chief scientific officer, whatever you want to call that individual. And they kind of did a tag team during the presentation. And I thought that went really well. I've seen, probably 10 to 15 where they did that kind of dual approach, and allowed them to have one person talk in an intelligent manner about the business side. But inevitably for those types of companies, you're going to be fielding a lot of questions on, the the medical aspects of it. And so having someone who can speak, talk that talk is super valuable. So by no means do I think that you should just feel like it has to be one person only. I would just recommend practicing it and making sure there's a good flow to the presentation if you're using more than one person.
Hi, my name is Julia, and my business is in a very, very, very early stage. And I was just, I want to ask a question about the pitch presentation and the market research part of it, because so there are plenty of options: doing it yourself, hire a company, have a data analyst to help you with this. So is there any preferred way? Will the will the investor look at you differently if you did it yourself? Will they take you more seriously if it's like, professional market research?
Yeah, great question. And honestly, I think it's investor by investor. If you're just talking about like the pitch deck and kind of how it looks, there's some investors that really don't care, aesthetically, if it's a beautiful presentation or not. They're looking at the content. There are others that tend to just gravitate more towards, sexier presentations, and that's just kind of the way it is. Now, in terms of kind of like your market research and hiring a company versus doing it yourself, I would say that depends on the number of data points that you could collect and need to collect in order to get your point across. So, for example, if you're just trying to solicit, sending out a survey to people and trying to collect feedback, or just data points on whatever, and you only can get 200 to 300 folks, that might not be enough data for to sway an investor to believe that there's validity to your product or service. Whereas if you do hire a professional group, they'll obviously hopefully get greater numbers of participants in that survey, and that data may hold stronger for the investor. But I think it's just dependent on what your business is. All right, anything else? All right, well, I appreciate everyone's time. And again, if you do have any questions, hopefully, here's my email, LinkedIn. I'm sure it's distributed by West Slopes, but feel free to contact me directly with any questions. I'm always happy to chat.
Well, thanks for your time today, Kyle. We certainly appreciate it. Good to meet you in person, and make sure to connect with Kyle. And if we don't have any other questions, we will give you back a few minutes of your day.
All right. Thanks everyone.
Everybody.
Have a good rest of the week.
Bye-bye.